Good afternoon, everyone. This is Faith Howard Mooney from TMC, and this is the last week in Mortgage Today. We're going to let some people roll in here for just a couple of minutes. But while we're doing that, hi, Pat. Good to see your face. We have with us today Jodi Hall, who is the president of Nationwide Mortgage Bankers. Very happy to have you with me today, Jodi.
Thank you for having me.
Not a problem at all. As everyone joins the conversation here, we do love it if we hear from you in the chat. So please share with us your thoughts and comments as we get going here. Jodi, let's start out with, I usually like to do positive, negative, positive, but we'll just go directly to the lesser happy news as we start today. Fourth quarter of 2022 for IMBs, not a kind spot to be in. So we just kind of like love your thoughts there on, the numbers and what they look like and what you've experienced as well.
Yeah, for sure. So I thought that we had topped out when we got the third quarter numbers of over $11,000 cost to originate. But lo and behold, we outdid ourselves for Q4, and the cost to originate a loan went over $12,000, $12,450, and also causing us the cost to originate a loan. So yeah, we are losing money for every loan that we originate as IMBs. But the Q4 was just over 2,800 loss per loan. So staggering numbers. And I think that kind of lends to, we've known, right? Like we've been talking about this story, and the question is did we talk about it and we willed it to be true? But we've talked about the rising cost to originate and the way that we can impact that, which one way I'm not willing to do, because then I feel like you're at a disadvantage from a recruiting perspective, is some people want to go after LO comp. And I think that then you're going to lose production if you're going to do too much adjusting to LO comp and make yourself not be competitive in the market. But the ultimate way to combat the rising cost to originate loans is through technology and being able to drive efficiency and have the very skilled and expertise individuals that are on your team work on very skilled and expertise functions, not on functions that should be completed automatically. And a lot of that coming through not robotic process automation, but a lot of AI and direct to data source. And it also helps clean up your quality assurance, your QC process, because systems have the ability to validate that information as you go. So one of the things that we've been looking at, because I'm like, okay, we've been really focused on investor suspense fees, on buybacks, on early payment default, early payoffs. So that cost does not represent what you're losing from investor suspense fees, because it's unrealized. It's like you were expecting X number of dollars, you got this number of dollars, so that there's even a greater loss in what we're losing per loan. So we've been focused on that. How can we, if you pay attention to it, you dig into the data, you look at your processes to try to drive that down, you have a greater loss than $2,800 a loan if you don't have your investor suspense fees under control.
Sure. Totally makes sense.
Yep.
Totally makes sense. And I mean, at this point, who wants a greater loss? Nobody.
No, we're in the game to make money. I know it sometimes feels like it's a not-for-profit, but guys, we're in a for-profit industry.
Yeah. Moving on to maybe a little bit lighter news than that. I think that we talked a little bit earlier. I couldn't find, I just saw a quick blurb go by my screen this morning and couldn't get into the article to read it. But they announced this, someone announced this morning, legitimately, I only saw the headline, so I'm not going to say that it's valid. But the cost of home, average cost of home, disparities between the West Coast and the East Coast, with the East Coast rising and the West Coast dropping significantly. Again, headline, wasn't able to read the article, hope to dig into that a little bit further this week, but share with us kind of like what you're experiencing in the markets that you support related to the cost of housing and availability of housing.
Yeah, so another topic that is the broken record that we keep replaying is lack of inventory. So in most of our markets, we're seeing the lack of inventory continue to be a challenge. I was in our corporate office in Melville, New York last week, and I was talking to one of our branch managers and his loan officer. And between the two of them, we do underwritten pre-approvals. So we have tons of underwritten pre-approvals sitting out there, and borrowers are searching for homes, and the length that they're searching for homes has become longer and longer. But they told me over the weekend, they had 8 borrowers who had put offers in on homes and only 2 won.
Wow.
So it's like we saw that little bit of a dip in interest rates really get everyone excited, but we still have the inventory problem. So by not having the inventory and homes not going for sale, like it is, I feel like we could be this March and April could be like 2021 if we had the inventory. We're seeing the same thing here in the Cleveland market. A realtor called me the end of last week and was telling me in my area, home went on the market for around 400,000. She had 55 showings in 3 days and accepted a cash offer 50,000 over asking price. And we tend to talk about in media all of the negative things, and we talk about rates are up, inventory's down, everyone's on the sideline, mortgage lenders are screwed, it's too much money. But there really is, in different areas, it's the tale of two worlds between inventory and home sales. And it's astonishing. But I do think that I don't think we can catch up on the inventory to make home values across the United States go down.
It's like a hard topic, whether it's the municipality that you live in, whether it's the view of, the individuals in that network. I know recently I moved and I experienced in 3 markets that I wanted to live in, I found nothing. I finally called a friend and found a house that was under construction, and they were getting, they were moving it to move. And so in some markets, I think it's really hard, and maybe only new construction in markets. I did do some digging on, I think we've talked about this before within Network, that there are all kinds of thoughts and ideas surrounding how do you build a home that is different than how it's been done currently, and how do you do that. So this year at the South by Southwest conference in Austin, there was a panel out there that they brought together 3 innovators that had decided that they were going to they're trying to do things differently, specifically with the idea of lowering the costs in a way that production of homes can be to scale. And so one of those was moving things offsite. I don't know if you've ever heard, it's a Virginia-based builder called Van Meter. And they have decided to, when they arrive at the job site, their cost per square foot is $100 on a new smart townhome. So multifamily, not single family dwelling. But the national average is more than $240 per square foot building how we build today. So definitely moving off site. They did note though in their presentation that it's very resistant to change market environment that we're in. I mean, builders just don't want to change what they're doing. And then they're also building a scalable hurricane and tornado resistant home with apparently something that's carbon neutral, some sort of new carbon neutral concrete. I thought that was kind of interesting. Have you seen any type of that housing move into where you are at?
Not into our markets. Most recently, I would say that modular homes probably have a bigger presence. And I think that largely has to do with lending, because the agencies will lend on mobile homes and modular homes. So that has been the biggest space of pickup. But I have seen, I think it was on, like one of the more like weekend morning shows, and I saw the hurricane homes that were fabricated in a factory and then moved to a location. Here's the thing, like, I don't know if we instilled that the American dream had to be a stick-built home, but it kind of feels like that is the unsaid. So there still is a stigma behind manufactured homes, modular homes, and everyone is resistant to change. It's not, loan officers, operations, home builders, everyone is resistant to change. And I think that part of that has to do with people's mindset and the stigma behind it's not a stick-built home. They want that craftsmanship and they want the customization. And I also think it has to do with lending. So I think if we see, that 3D printed homes, we can get financing for them. Listen, we're a mortgage lender. If we can lend on that house and we can sell that loan, we're going to do it all day long. But I do think that there has to be some form of kind of break in that stigma. And I think in different areas, it's more acceptable, right? So you'll see like manufactured homes and modular homes, big in Florida, in Arizona, in Nevada. So there are some areas where it's less of a stigma. If you're not in those markets, you're not taking advantage of it. But I think that there will be a shift to that just purely because of cost.
Yeah, one of the other providers in this same session was an Idaho-based company out in an area where it probably is a little bit more frequent that we're building modular homes. The name of the company is Autoval for anybody that wants to work them. They're working on multi-story projects, so more than one story. I thought it was interesting. So it's a new terminology in the mortgage industry this week for me. So one of them I learned was solutioneers. Instead of your people, they're saying that robots work alongside the company's solutioneers. So that's what people have been called now. To build 5 wood frame modules per day, then they're connected together into a 5-story residential building. Which is crazy. Something I know. It's like I've seen modular homes, obviously, but not a 5-story multifamily building. When they delivered their first project, they're claiming that it was within a 1/8 of an inch of tolerance for the 5-story building, which I thought was actually pretty incredible. That quality, obviously, for them has been there. $140 a square foot versus the $240. But multifamily residents. So they're in the process of building 7 plants for other housing developers. And then you mentioned also the 3D printing, which I think I know in some Lennar developments, I believe in Florida, they had a project going that they were doing that, but there's a California-based company called Mighty Buildings that's doing that whole 3D printing. It's a prefab sort of startup company. They're more in the 300 to 350 square foot range, but they're saying homes last for 75 years. It's like, do we want homes to last for 75 years? I mean, maybe we do. I don't know.
It's a 75-year-old tiny house.
But I thought it was really interesting because all of them also along with that are working, I mean, reduce costs, but they're also looking at sustainability things,
Right.
and,
Absolutely.
environmental things, at the same time. So I thought that those things were kind of interesting when I went back and looked at them.
One
Um,
that I'm fascinated by are container homes.
oh, you
And
have
you think
those here.
about if you have you have a steel box. So in areas like where there are hurricanes or there are tornadoes, you would have to think that container homes would be much more sustainable. Plus I think there's less of a stigma just because it's cool and trendy, especially in urban areas. Um, I saw one, I'm a huge like horse barn fan, but I saw containers that were it was turned into a horse barn, and then above, so they stacked two containers side by side, and those were opened up on the inside, so they became the stalls. And then a container stacked on top of it was the living area of the home. And so I think that there's also alternatives. The other thing we have to think about though in the industry is the municipalities and the regulation. Are they going to allow zoning that allows container home, 3D printed homes? In a lot of areas, like everybody wants to solve the inventory gap with these ideas, as long as it's not in their area.
Yeah.
So it's like such a political game too, and we have such a long way to go. When it's all solved, I don't think that I'll still be in the industry, but maybe 30 years from now, we can do like comeback tour and have a conversation about it, Faith.
Yeah, yeah. I mean, it's very interesting to just so I live in one of those communities that's been very resistant, and
Mhm.
I've been in this general area since 1987, so I've been here for a long time. But we're starting to see things open up, and maybe it's because I mean there have been some studies that have been done out there related to what is gained from. I mean, I think it's always looked at from a loss, right?
Yep.
What is that community losing?
Yep.
It tends to be, well, what is there to be gained? I mean, it's like it can be looked at that way. One of the ones that I found this week out there, it was a study by the University of Chicago and UC Berkeley that they did, and they said if New York, San Jose, San Francisco, so all high cost areas, right? Loosened up their zoning restrictions because they all apparently have zoning restrictions that forbid high density housing in them. The GDP would increase by 9%. And that 9% equates to average annual earnings in the United States rising by roughly $8,700. And it's like we always look at those, I feel like, from the negative side of things.
Yep.
And it's like, what is that community losing? Well, what is that community gaining?
Right.
And I think that that's kind of been one thing that's kind of been lost, on us looking at maybe as our municipalities or our towns. It's always seems like it's viewed as a negative thing.
Yes.
um, Kind of going into things related to people are now we're looking at, obviously there's been some really unusual weather across the United States, um, very high snowfalls in the West that
Mhm.
are kind of like, I saw something over 630 inches of snow, which even from being in Minnesota seems crazy.
Yep.
We don't get anything near that, but causing Fannie Mae to begin to look at tackling what the climate risk is. So I would just love to kind of get, if you've heard that, any feedback that you have on what you think they would, obviously it comes into play potentially in the underwriting
Mhm.
stream of things for a lender member. But would love any feedback that you have related to what do you think they would, speculation on what you think they would be looking at and considering when they're looking at those types of things.
Yeah, it definitely makes the Midwest look like a glamorous place to live, doesn't it?
Uh,
Um, so all of those,
Tornadoes, maybe.
Yeah. We're pretty safe here in Cleveland. Same thing, like Cleveland used to average over 100 inches of snow a year, and we don't see that. We don't see that now. We see very little snowfall. So it does. The biggest thing is insurance. And there is just in Florida itself, the homeowners insurance is a big deal to be able to get in areas that you need wind insurance and that you also need flood insurance from the hurricanes. The premiums are astronomical if you can get them. So I think that from an affordability perspective is going to push a lot of borrowers out of the mix. It's also hard for mortgage lenders, and this, doesn't have anything to do, with lending, but if you have large servicing portfolios that are in areas of natural disaster, your financial risk is insane. I remember having a huge servicing portfolio and I can't remember what the year was, but Florida got hit on both sides of Florida, huge impact on hurricanes. And I remember that year, the amount of loans that we had in the servicing portfolio that we were just trying to even see if they're still standing. So I think that, definitely being strategic, it has to come into when you're going out and you're developing your strategy about where you're going to lend to or where you're going to recruit new branches to come in. It has to come into play because it's a train wreck for your operations staff if it happens for loans that are in process, although there are better tools that make it easier to get your disaster certifications and getting them electronically without having to be there. But then if you have a large servicing portfolio in those areas, it's a tremendous amount of risk for lenders. Then if, the agencies are going to try to change, underwriting guidelines by geographic area, it's just going to make it harder and harder to lend in those areas. And it's like, then is it just like all cash borrowers live in high impact areas? Like, I don't know where it goes from here, but it definitely is something to keep in mind as an IMB or that is, growing, or a credit union or a bank that is expanding about the areas that you go into.
My mind went a completely different way, and it leads us into a different conversation that somebody asked about in the chat. So I'm going to go there. It kind of went to, okay, are they looking at this because there's going to be some sort of risk-based pricing adjustment done on those types of transactions? They did say that they're at least 2 years out. So there's a time frame there.
It's amazing how you're like 2 years out for the things that you want really, really bad, and things you don't really want seem to happen faster.
Yeah, so that leads us right into the question that's in the chat. So, which of course you and I are familiar with because we've been working on something this last week related to the ETI loan level pricing adjustment. The comment is even though it's been pushed back to loans purchased until August by the agencies August 1st, obviously you're going to start seeing it applying in your process when 90-day locks, 75-day locks, 60-day locks, due to the delivery times to investors. So it's been 2 weeks since the delay, but it's going to start rearing its ugly head again. So this comment says very quickly, care to comment on that one? I know you do.
Well, I don't see this in the chat. Oh, it's in the Q&A.
It's in the Q&A. Yep. Yeah.
Let me see. Oh, and of course it's anonymous. I was going to ask them if they attended the TMC conference in San Diego, because I think everybody got my thoughts. Got my thoughts there and then.
And your questions.
Yes. I am cautiously optimistic that this is going to be. I think that the 3-month holdout was to collect more information and kind of go back to the drawing table. And I'm cautiously optimistic that this is one that we will see go away. And part of the reason has been because of all of our voices, all of the voices coming from other co-ops, coming from different conferences. And the mortgage industry has been big loudmouths on this one. And I'm hoping that causes the change to the rule, because the biggest thing is going to be from an operational perspective, like, what do you do? It means you're going to have to calculate your income at the very first, and then, hope that the borrower, we always tell borrowers that they shouldn't open debt while they're trying to purchase a home, but everybody buys a BMW when they're purchasing a new home and they only have $100 in their account for down payment. But you can't guard against that one. So I'm optimistic that's going to be pushed. So let's keep talking. So everyone that be a loudmouth and try to push and advocate for that to go away. And I'm optimistic for that. I think that we might see a slight increase in other LLPAs to adjust for that, because it was such a big part of what FHFA's capital structure was and the reason that they were implementing it at first. So I think that we might see a small increase across the board, but maybe that one will go away.
Yeah, and just so people are aware, we haven't announced it yet, but we will be sharing it out when it goes out. TMC is involved in creating a letter based on a conversation that some of our lender members did have with Chris Dickerson while at our conference, and are sharing concerns in a letter format back to Sandra Thompson and Chris Dickerson. So it does appear that they are listening to what we're saying. Stacy, thanks so much for the comment in the chat that per Fannie and Freddie reps at the MCCT conference, they said prepare to implement it. It was time delay to operationalize, not to reconsider. So I guess we'll, just kind of have to wait it out and see. Yeah. Also, we're down to under 5 minutes left. It seems impossible that goes by so quickly, but we do have one other comment that I would like to get your opinion on that is in the chat as well. Pat, thanks for sharing this or asking this. Are you seeing repurchase demands from Fannie increasing due to appraisal issues, specifically anything with a 4+ CU score? How about you, Jodi? What have you seen on that side of things?
Yeah, we actually talked about this also with the large IMB roundtable at the Mortgage Collaborative. And I said, we actually haven't seen that. Well, I jinxed us. So
oh, no.
I came home from the TMC conference to two Fannie Mae repurchase requests related to appraisal and CU score that we had done everything on. And I believe it was, I think it was Danielle from Thrive was talking about this, and like, what do we do? Because we feel like we're meeting all of the requirements. If we have the CU score that is over, we're going out and getting desk reviews to further support that. And we're providing all the documentation to further support. And it's funny, one of them, we were like, good luck, whatever the area was is on Long Island. And we were like, yeah, good luck finding a home for $350,000 anywhere on the island, especially in that area. Like nothing goes for less than 500,000. So we thought like it was a slam dunk cleared, and we have been fighting that. So yes, based on the feedback from other members of TMC in that IMB roundtable, a lot of people are seeing a lot of the pushback on appraisals with the CU scores that are higher. And we don't really have a solution for it. And what I mean by that is we feel like we're already meeting the requirements and addressing them in the manner that we're supposed to. And we're still getting pushback for repurchase. So would love to collaborate with other lenders if they have been able to successfully fight that. And maybe that's one of the things that we talk about in our operations working group for fighting CU scores, that let's go to 3.5 and above.
Yeah. Great idea. Yeah, I mean, that definitely is something that would be a great topic for that operational working group, which I wish I had the date. If one of you on the call with me has the date on when our next one is, it would be great for you to pop it into the chat while we're on here. Yeah, let us know, Pat, if you want to make connections there, because we gladly will connect people individually as well through our team to talk through that particular issue and give you any best practices from anyone else. So 419, thank you, Amy Bohr, is our next operational working group. So that is a ways out. So if anybody wants to get together and talk about that sooner than that one, let us know. If not, you can find the Zoom registration link in the chat here with us today. We're at the end of a half an hour. It seems like it goes by so quickly, but of course I could talk to you for like 3 hours a day if either one of us had the time.
Same.
Super appreciate you doing this for us as always. You've been a great contributor to our network, and you always come to our rescue when we hit you at the last minute. Can you hop on here? So we appreciate you, Jodi.
I appreciate all of you. Thank you, Faith.
Thanks everyone for joining us, and join us next Tuesday. Same time at 2:00 Eastern time for the last weekend mortgage today. Thanks everyone for joining and for your great comments.
Bye, everyone.
Bye.